We're going to go. We're going to talk about all the things we need to talk about, but what I'm going to try to do, my goal is to reduce the first hour. Well, it's usually an hour and a half. I'm going to try to reduce that first hour and a half down to about an hour or 50 minutes for the high probability trend trade. I'm very, very willing to go longer. So if you have any questions, please interrupt me. But my goal is to create more time to watch live markets, more time to look at your charts, more time to answer your questions. So we'll see how that all works out today. It's anytime I jump out of my comfort zone, I stumble a little bit, which is okay. That can be expected when you're doing something new. Good morning, everybody. And then we're good. Um, and then, Paul, we'll cover those strong tops and bottoms today. We'll make a point of covering strong tops and bottoms today. We'll not only cover what they look like, but we'll also talk a little bit about what they mean to us as traders. But before we do that, my brother is still trading with me via Skype. Before we do that, what we're going to do is we're going to go through and kind of do our routines. We're going to talk. Make sure that we check news each and every morning. Make sure that we just look and make sure that there's not any big news releases that might mess us up. Today is Monday, May 6th, and at 12:50 p.m., Barkin speaks. It's low impact. Sorry, I'm having some challenges today. It happens, and really, there's not a lot of news coming on until Wednesday. So I guess that's a good thing. We're not going to have a lot jumping in front of us. But I do check every morning. I want to make sure that I'm not trading when there's a news release. Um, Me personally, I don't want to be in front of that emotional reaction that can happen. But if you are with one of those prop firms, if you're with a funding firm, most of them are pretty adamant. Don't trade into news. Don't put yourself in a position to be a victim to somebody else's emotional response. So we check it every morning. I come through, take a look at it, make sure that there's nothing going on. And then once I do that, I move on with my day. Um, Everything that I talk about in the room, guys, is going to come from the education page. And I always pop it up here, and I really don't do a whole lot with it. But your software user guide is your NinjaTrader how-to, guys. Anything that you need with NinjaTrader, you're going to find in there. If you have questions, if you're having NinjaTrader problems, please pop them in the room and say, hey, Mark, have you seen this before? Can you help me? Chances are I've already broken it and I know a fix. So we'll see how that works. Don't ever be afraid to ask a question. But guys, we're going to focus heavily today, at least for the first hour. We're going to talk about a high probability trend trade. And we talk about this trend trade, and I talk about the same trade every day. So if this is your second or third day with me, you're going to be saying to yourself, wait a minute, this is the same darn class I saw on Friday, and it looks just like the one on Thursday. And the reason for that is because when you hear the same thing over and over and over, what happens is it begins to sink in. Um, it's almost like somebody nagging in your ear, which is my job. My job is to nag in your ear. We're going to talk about a high probability trend trade. We're going to talk about a trade that typically wins 70 to 80% of the time. We're going to talk about a trade that's based on advantages, and it's a trade that teaches you to be a chart reader, and that's why this is up here. And that's really the goal, is that you can just look at your charts and understand what they're telling you. Hey, good morning, Andy. Good to see you back in here. Um, Oh man, everybody say good morning. Sorry guys, and Paul and Muser and Erla and Cav and Zorro and Rob and Andy and man, good morning to all you guys. Um, Sorry, I got so caught up in my spiel that I missed. Chart reading is going to play a pivotal role. Chart reading it's literally going to be like 90% of everything that you do. And I know that that sounds like a lot to do absolutely nothing, but man, that's the path, guys. That's how you get to where you want to be. Being willing to do absolutely nothing when there's nothing to do. So chart reading is going to be the majority of your day, and you're muted again. Guys, give me a Y if you can hear me. Okay, you guys are good. Give me 1 second, guys. There we go. I need to figure out where that unmute is, so that I'm not sure that it's that. Slow reading emails. I am, Rob? I may be. Oh, okay. No worries. Um, that's okay. I was like, man, I check them all the time. Um, all right. So hopefully we can get Andy fixed up there. Guys, if you're ever muted, killing it via your task manager brings you back a lot. Get back to where I was. We're going to talk about the high probability trend trade. We're going to focus on chart reading, guys. You're going to be able to look at your charts and you're going to understand where the market is likely to continue. You're going to use that for entries. You're going to understand where the market is likely to go. That is going, thank you, Cam. Thank you, Cam. You're going to be able to understand where the market is likely to go, and this is going to help you make great decisions on targets, and you're going to understand where the market is likely to stop, guys. And this is one of the biggest things for Nexgen users. These likely to stop areas can kill a trend. They can kill the forward progress of the market. These likely to stop areas can behave as anchors, setting you up for the highest probability trend trade ever. But I think that the sooner you get comfortable with the idea that you'll do a whole lot of nothing as a day trader. And what you'll actually find is that the less you do, typically the more successful you are, because you're going to learn to speak to yourself in terms of advantages, and you're going to be able to focus on these three concepts and turn them into trade entry precision. And that entry precision from the high probability trend trade is going to put you into that trade that gives you the opportunity to find success as a brand new user. That trade that teaches you three simple rules with just three advantages that will echo throughout your entire trading career, making you more efficient, giving you more opportunities. So we're going to go from chart reading to trade entry precision. From trade entry precision, you're going to have to work on management. We'll work on it together. I am here 15 hours every week. We're live, and my whole goal is to give you these rules, to talk you through them, and to give you feedback. To give you feedback on everything that you see, to give you feedback on everything that you do, to give you clarity on any concepts that you're unclear on. And I love that part of it. It's the feedback that makes this class great. It's y'all's questions coming in and asking me the things that I didn't think to say. Because, guys, everybody sees things differently, and everything registers at a different pace, or it resonates in a different tone. And when you come and you say, hey, Mark, I need a little help with this. This is how I see it. Am I doing this right? Well, then it opens the door for stuff. And you're going to do that by posting your trades in the classroom, making sure that you're just showing me what you're doing. Show me your chart reads. Awesome, Andy. Cool. Welcome to the room. And then also use the spreadsheet that Nexgen provided you. If you go to your study picks folder on your computer, there's a spreadsheet that Nexgen has given you. I drop mine in the room every day. I try to share mine every day because I really update mine every day. So I'm going to drop it in right now. But this spreadsheet, hold on 1 second. Andy, Control Alt Delete, kill Discord, come back in. Sometimes there is audio glitches that this fixes, and it rhymes, so you know it's fun. And guys, that's the best way. That's what I do in the morning if I have any challenges, is I go to my task manager and kill it through the task manager. And I didn't put that in there. So guys, there's 4 tabs to your spreadsheet. There's the tracking sheet, and this is where everything that you do is going to go. You're going to talk about what you see, what you did, all the feedback that you received in class. There's your favorite looks section, where every time your rules are met and there's that advantage, this is you building pictures for your trading plan. And then there's the client trade section, which is about 300 pictures of next-gen users finding advantages and turning them into trades. And most of the charts are annotated. They're annotated talking about advantages. And this is a great place to study, to go through, to look, just to get some familiarity, to make sure that you're comfortable with what you're seeing. This section also has entries, it has management, it has patterns that repeat itself, and a whole section dedicated to those likely to stop areas, because what you'll find is that those are probably the most important areas on the chart. So if you post in the room, you're going to get feedback. It's like a private session every day. If you use the spreadsheet, you're going to create recognition through repetition, guys, and that really is the step-by-step path to getting to where you want to be. We're going to learn trigger line and Fibonacci rules for when it's okay to trade. You guys simulate all day through class. Post them in the room. Show me everything that you see when you do it. And I put this together over the weekend, guys, how to annotate your charts. Annotating your charts is how you're going to get the best feedback. Annotating the charts lets me know what you see when you're reading your indicators. Annotating your charts is giving you something to come back and study so that you can get better at this. And the goal is for you to get the best feedback possible, which means the more information you give me, the better the feedback's going to be. So show me both of your charts. Show me the timestamps. Show me the prices. Let me line up the big charts and the little charts. Talk about your advantages. Show me your entries. Show me your exits. And what we'll do is we'll go through and we'll talk about each and every one of them. So do that when you simulate. Go in and talk about it, and then we'll talk about it together. Simplify. Keep it easy. Keep it focused. Keep it streamlined, guys. What I find, and I've been doing this for years now, is that the people that look for less tend to find more. The people that aren't trying to catch every move typically catch the best moves. The people that aren't focused on doing what other people do, but rather doing these easier, higher probability trades, are the ones that are finding success, guys. But you've got to learn the looks so that they become easy. That's where that spreadsheet, filling out your spreadsheet, making sure that you go through and flood this thing with pictures. It's going to make your life a lot easier. We're going to go through it, start talking about this high probability trend trade. And the reason that we do it, the reason that the high probability trend trade is the focus, is, guys, it's easy. It's only two charts to recognize this trade. We use a large chart and a small chart when looking for the high probability trend trade. The large chart is a slow moving chart. It's a very broad stroke of a brush, and it's the most current bar that will define direction, momentum, and areas, guys. Direction's the easiest lesson that you're going to get today. If the background is green on your large chart, it's going up. Go up with it. Easiest path of least resistance. If the large chart background is red, the market is going down once again. Going with the large chart tends to create this huge advantage. It's going to define momentum. It's going to define areas. And the small chart is nothing more than an entry chart. It's just finding a way to get in where the market is most likely to continue. And the reason we use two charts is because there's really two forces in the market, guys. There's the large crowd that moves everything, that creates momentum, that establishes direction, that reacts to areas. Andy, are we loud and clear? I hope. I see that you got back in. I just want to make sure. And then there's a small crowd. And that's your small chart. And these are the guys that typically fight the large crowd a little bit. And we're going to use them. We're really going to take advantage of them to get us to the best of the best spot, the point where the market is most likely to continue. And it's this two chart process that's going to allow you to recognize these three rules. And these rules are designed to create advantages, or the advantages are a result of the rules being true. Rule number one, strong triggers on your large chart gives you the advantage of momentum. Rule number two, no termination conditions. That's those likely to stop areas. Not having any of those in play is going to give you a clear path, room to your targets. And then rule number three is designed to get you into the market where the market is most likely to continue. So we're going to run through each rule. We're going to look at them. We're going to see what they look like. I am struggling to keep NinjaTrader open right now. I tried to do a rebuild, but I realized that I ran out of time, so I kind of half-assed it, pardon me on that. So I'm going to do a quick little, see if I can't get everything to open up here. Even stole one of my brother's workspaces just to check mine against it. So let's see if I can do this in the background while we talk about rules. And we're going to focus on rule number 1 real quick, guys. We're going to talk about strong triggers because strong triggers are going to give us the advantage of momentum. And momentum means that the market is likely to continue in whatever direction it's going. So when the background is green on the large chart, both your small triggers, the solid lines, and the large triggers should be green. And when they are green, same color as the background, sorry about that, the small triggers need to break above the large triggers. And it's the space created between the two. I'd like you to imagine scissors opening. Because when scissors open, you're able to cut, you're able to get work done. So when these scissors open, when the smalls break above the large, when there's space between the two, this lets me know that the odds are favorable for the market to continue up. It's the advantage of momentum through strong triggers. In the classroom, you're going to hear very often odds favorable momentum, and you're going to hear that a lot. And that's kind of our battle cry, is a market that has the potential to continue up because of the momentum. In a downtrend, when the background is red, you're going to be able to recognize the scissors opening, the small below the larger wide. And once again, it's the space created between the two that gives me that odds favorable momentum. It's that gap between the small and the large. And the gap doesn't last forever. So for the brand new user, when you have strong triggers, this is your highest level of advantage. This is where on a smaller chart, we're going to buy Fibonacci support when everything is going up. We're going to sell Fibonacci resistance when everything is going down. And this odds favorable momentum pushes that market. This odds favorable momentum can break through key areas. This odds favorable momentum will even cover some of the mistakes that new users make. When you look at that large slow chart, you'll see that there's these tails or these wicks. These are actually those small chart pullbacks, and you will be able to pinpoint. I'm going to say by the end of your first week for most of you, you're going to be able to pinpoint where that market is most likely to continue. You're going to use a smaller, faster chart to identify exactly where that tail is most likely to form. Odds favorable momentum is something that does not last forever. For the brand new user, strong triggers is your highest advantage. It's okay to commit 100% to strong triggers in the beginning, because when you begin to become a chart reader, when you begin to recognize advantages more readily, you'll notice that when one line of the small triggers works their way inside of the large triggers, you know that momentum is slowing. You're speaking to yourself. You're saying to yourself, man, the momentum is slowing. It's not perfect anymore. I can still go short, but let me utilize my chart reading to make sure everything is in agreement. And then once small triggers break inside of the large triggers, once those scissors are closed, if you will, this is a visual. This is a weakening or a slowing of the trend. And the language that we use is that anything can happen up or down. So for brand new users, the idea that gap between the two, it's going to create an advantage. And that advantage is going to carry you to areas. That advantage is going to allow you to see a market, and you'll recognize those tails giving you a potential entry. But strong triggers is going to be the same no matter what chart we're looking at, guys, whether it is a large chart, a small chart, a range chart, a day chart, a month chart, a Tesla chart, an Apple chart, it doesn't matter. The separation between the small and the large, guys, this is my advantage. And when those trigger lines return, when they come back, that advantage begins to go away, and I lose that advantage of momentum. Is everybody cool with that? Is everybody all right with that very simple look? Just focusing on momentum first, because momentum, guys, it should always lead the way. And momentum gives you a very clear advantage. Once you have that momentum, you've got to make sure that you're not trading into areas, that you're not arriving at any of those areas where the large crowd is planning on reacting. The areas that we're looking for, and then once again, it's on a large chart. We're looking for divergence highs, divergence lows, red resistance, blue support, yellow one-to-ones. The easiest way to remember termination conditions is that they're just lines on the large chart. Lines on the large chart may be problematic. Lines on the large chart may stop the market. And these lines can cause trouble because that's where the people in charge may react, where they may be buying or selling or taking profits, or even identifying where buyers and sellers, that large crowd, might get into just an all-out brawl with one another that you don't want to be a part of. We're going to use the trigger lines, the same trigger lines that establish momentum, and they will let us know if these areas are likely to stop, if they have the potential to break, or if they're broken. And there's really two options for the brand new user. The first one is that when price reaches an area, and let's use that as the beginning for everything with termination conditions. Price must reach the area. Your dynamic Renko bars must come down and reach the area because that's what sets off the decision-making process. If price reaches support and the triggers remain above, no more short trades. This is an area that may stop the market, and it really is that simple. And it even happens on retracements. If price reaches Fibonacci resistance as it pulls back up and all the triggers are below, well, this is an area that may stop the market, that may create a bounce. So this is your first one. This is how you identify a termination condition. If price reaches, triggers remain above support, below resistance, the best thing for you to do is really absolutely nothing. So if price reaches Fibonacci support like it did here, and the trigger lines remain above, this is where we're going to sit on our hands and do nothing. If price reaches a divergence high line and the triggers remain below, we're going to sit on our hands and do nothing. You can see how it bounces directly off of support. You can see how all the triggers are above support. It continues up. And this repeats itself over and over. So identifying a termination condition is that very simple recipe that never changes. Price reaches an area. If the triggers remain above support or below resistance, it's okay to sit on your hands and wait to see what that reaction is. We will consider an area to be broken when both the small triggers and the large triggers, both lines of both, get below support. Support behaves as resistance. The area is considered broken. The path is now clear. The same is true. If price reaches resistance, it's not until both the small and the large triggers get above that area of resistance that we'll consider that area to be broken. And for you brand new users, there's really two options. If price reaches an area and the triggers remain below resistance, above support, go ahead and train your brain. I don't have to be in that trade. I don't have to hope an area breaks. I don't have to wish or want. All I really have to do is be patient. The market will either reverse or it will break. And if it breaks, I'll know that it's broken, not because of the color of the fib, not because of the price bars, but because both the small and the large triggers get to the other side of the line, whether it is resistance or a divergence high or those yellow one-to-ones. And that's the basic, guys. That is the easiest of the easy. Odds favorable starts the process, making sure you have a clear path. And that path remains clear until you hit the next area, until price reaches the next area. There is one other scenario that we're going to talk about, and this is going to be what we call a medium probability scenario. Strong triggers can break areas. Strong triggers can smash through fibs. If they didn't, we'd be stuck in this range forever. So when your small triggers smash, explode, annihilate an area 3 to 4 points above, and those large triggers are lagging a little bit, they're a slower indicator, these are areas with the potential to break, and that potential is heavily reliant on the odds favorable momentum. Strong triggers break areas, or have the potential to. So when the smalls are above and the large are below, 50% of my triggers are through the area and 50% are not. Guys, this is what we call a 50-50 trade. And a 50-50 trade is a medium probability trade, not a high probability trade, because we do not have a clear path. We only have the potential for a clear path. So there will be three scenarios for the brand new user. There will be price reaches support, none of the triggers break, even with the momentum, sit on your hands and do nothing. Price reaches a divergence high, the triggers can't break, don't go long, the market may reverse. Those are both pretty clear. And then you get where the smalls break through, but the large don't. That path isn't clear yet, and look how it reacts. It ends up pushing up. And even over here, the smalls begin to get through, but the large do not, letting me know that my path really isn't clear, guys. And you're seeing this little bit of indecision hovering right around these key areas. So here, price reaches resistance, the triggers remain below. The small triggers say that it has the potential to break, but it's not really broken until the small and the large go through. And it doesn't even matter what color the fibs are. And people like to focus on that fib color. If I cover the fibs and just make it white, let's see if I can make it a big fat white line to where you can't see those fibs. This little drill reminds you that it has everything to do with triggers, and it doesn't have anything to do with that fib color. So get that recipe in your head. Learn how to write it on your charts every time you reach an area. So if I were going to take a picture of this crude oil chart right now, I would simply say, oh, but I'm backed up a little bit, has price reached an area? Where are my trigger lines? And that's the recipe every time. Every time I'm looking for a trade, that's the same thing that I'm going to ask myself every time that I reach an area. Where are my triggers? And guys, that's rule number 2. And rule number 2 can keep you out of a lot of mess. Even with momentum, price reaches yellow 1-to-1s, the triggers remain above. There is no trade to be had. It's not a clear path. You've reached an area that may stop the market. And the bounce that it creates goes directly into resistance, and all the trigger lines remain below. And then you find yourself in this position where you can't go long, you can't go short. 90% of your day is spent waiting for advantages. And the cool thing is your rules keep you out. You have a termination above, you have a termination below, you don't have odds favorable, and your rules aren't met, so you're not looking for a trade. And this goes on for nearly 45 minutes, guys. And the difference between successful traders, in my experience, and the traders that struggle a little bit is the patience. The people that don't take the trades without the advantage, that don't give that money away, that don't have to make up for it when that 10% comes around, because eventually all my triggers get above resistance and it's acting as support now. My path is clear. My small triggers are outside of the large triggers. I do have momentum. And there's one of those tails where you're going to be able to pinpoint where the market is most likely to continue. And this $450 worth of profit is an outstanding, that's almost goals met for most of the traders that I work with. But if you give 1,000 away, hoping, guessing, trying to predict what the market's going to do when the advantages aren't present, then all this is just digging you out of a hole, and hopefully all the way out of a hole. So guys, termination conditions are a large chart thing. Termination conditions use the line on the large chart to determine if it's problematic, if it's broken, if it has the potential to break. And yep, even when the smalls are through and the large are not, there will be opportunities for you guys to make money, but it's going to be very dependent on your ability to read charts. Is everybody good with that? Price reaches, triggers don't break, sit on your hands. Small and large are through, the path is clear, guys. This is a very basic 101 approach. That's a large chart scenario. Lines on the large chart cause problems. Lines on your small chart are going to create entries, guys. That's where entries are going to originate. This is where you're going to pinpoint where those tails are likely to form. But there is one termination condition that I will recognize on a small chart. Only one time when I will say to myself, rule number 2 isn't met on the small chart, and that is 3 divergences in the same price range. Divergence is a loss of momentum. You see it from a low because you get a negative number and a cyan line. The negative number, it's irrelevant. It doesn't have any weight. It's a byproduct of the calculation. But if it happens 3 times in the same price range, it may stop or terminate the market. If it happens 3 times in the same price range, it could create a bigger push, an untradeable push. The path is no longer clear. This becomes more powerful when your final divergence has those weak triggers, those anything can happen triggers that we talked about from rule number 1. It makes those 3 divergences more powerful, more likely to push the opposite direction. becomes more powerful still when it creates the third pivot is higher than the previous or lower than the previous from a high. It creates a head and shoulders pattern. And this adds even more fuel to the fire. So 3 on itself can terminate. 3 with weak triggers makes it more likely to. 3 with weak triggers and a head and shoulders, man, don't go short. But you're going to see those from lows and highs, and it's going to help you see on potential change that you won't see on that large chart, on that slow chart. Because the reality is this is a slow moving train, guys, and sometimes you're going to have odds favorable. But you'll have one divergence about right here, and a second one right here, and a third one prints right here, and you're not going long with that momentum. You're not going long with that clear path because your small chart gave you the indication that change was happening. And guys, that's termination conditions. I'm going through this at a pretty good clip, and I'm going to show you how to study these and get better at them. I'm going to show you how to do everything that we're looking at to make it a little easier. But I ask for whys in the room a lot. It's not for me, guys. I know this stuff. I want to make sure nobody's getting left behind. Large chart must have strong triggers, and in order for rule number 1 to be met, there has to be strong triggers. This provides you the advantage of momentum. I want you to talk to yourself in terms of momentum. I want you to say to yourself, I do have a market that's likely to continue in the direction of the trend. I do have the opportunity for it to continue moving. And then your large chart is also going to define termination conditions. It's going to let you know when we've reached an area that's problematic. If none are there, you're going to have room to your profit targets, guys. And what you're doing is you're coupling these advantages. You're literally speaking to yourself. I have momentum. I have a clear path. And then the flip side of that coin is that you'll be able to say to yourself as well, wait a minute, I don't have momentum. I don't have a clear path. Maybe I shouldn't be looking for this trade that isn't high probability. But once we have them established, it's time to look for an entry. And entries happen on the small charts. Entries are going to use lines on the small charts, areas on the small chart. And your rules for entry are going to get you to a point to where you're going to use a limit order. You're going to wait for the market to come to you at the best of the best spot. And you're going to use that limit order at an area. We're looking for fibs, mid-bands, and yellow 1-to-1s. But the key is that we want them tucked inside of trigger lines. Trigger lines are just moving averages. Moving averages are where the market tends to return to. And this is a small chart, and you can look at it here. When your large triggers and your synthetic triggers on a small chart, and there's 2 what appear to be large triggers on a small chart. When they are overlapping, when they are one on top of the other, when they are like 2 snakes riding piggyback, this is the best of the best. This is the look where I can fit the least amount of areas inside of it. This is the tightest, the most concise, the lowest risk, the highest probability entry that you can take as a new user. We call this overlapping favorable large triggers. And of course the opposite, I try to go both sides of the coin when I teach this classroom, is sometimes they will split. They will divide from one another. Your large triggers are native to the small chart. These synthetic triggers are nothing more than the large triggers from your large chart. So we expect price to correct to triggers. It's a mathematical thing. But when they divide, when they split, I double the correction points. The space creates, the window gets bigger, and there's a lot of indecision, and it decreases accuracy. So for you brand new users, one of the easiest things to do is insist on those trigger lines being one on top of the other, and you're just going to put it together. You're going to let the large chart say that you have momentum, and you're going to let the large chart say that the path is clear, and only when the large chart gives you this information are you going to come to the small chart. Are you going to dissect that one bar on a large chart and look at it on a small chart? I'm going to show you how this dissection works. This bar right here is only one bar, and it has momentum, and the path is clear, and everything is wonderful. Well, the top of this bar when the market is live is going to be the beginning of a pullback. And then the tail is going to be all the way down here. And all of the price inside of that one bar is this 30 to 40 bars on a smaller, faster chart. So we're going to use a simple recipe to define exactly where that tail is most likely to form. And we're going to do it with areas inside of favorable large triggers. So in order to identify where the market is most likely to continue on the small chart, the first thing we do is we wait for a reversal bar. And a reversal bar is that fight, that small crowd fighting what the large crowd says. And that reversal bar is not the entry for your high probability trend trade. The reversal bar is nothing more than the beginning of a pullback, a small retracement counter to the underlying trend. Once I get a reversal bar, I'm going to identify my trigger lines, my large and my synthetic, and hopefully they're one on top of the other because that's going to give me the smallest correction point. These trigger lines are where I expect the market to return. When it reaches the trigger lines, it is not my entry. I'm not expecting the trigger lines to stop the market. They just give me a range to look at to find areas, fibs, mid-bands, yellow one-to-ones. And these lines inside of trigger lines, this is where I expect the market to bounce. This is my highest probability entry. This is where the market is most likely to continue. Sometimes you may have a little bit of a range from the highest point of support to the lowest point of support. This creates a window, the window of opportunity, if you will. And this blue box represents the point where the market is most likely to continue. If this momentum, if this clear path is going to do the trick, going to continue that market up to Fibonacci resistance, these areas inside of favorable large triggers are the most likely point for it to bounce to continue its journey. So you'll see them for longs, and the recipe doesn't change for a short, and you have to go through this process. Reversal bar begins the process of looking for the triggers. The triggers are where I'm going to look for areas, and the areas are fibs, mid-bands, yellow one-to-ones inside of those triggers. If there is one line, one area, guess what? Your window of opportunity is one line wide. Talk about precision. You're going to activate a limit order just below it, and you're going to hope that that large chart does its thing. Areas outside of trigger lines are not a part of that bounce point. Your correction point, where we expect price to go, is from the bottom of the triggers to the top of the triggers. Where we expect it to bounce is the areas within. And guys, you're going to be able to use this very simple recipe to be able to come through and pinpoint where the market is most likely to continue. This is where you're going to have the highest chance of success. This is where the potential for winning is the best. This is where the risk is the absolute least. And this is where the profit potential becomes the absolute largest. Because what you've done is you have taken the space to your next area and almost doubled it by waiting for the pullback. So for longs, for shorts, and then my favorite part is that once you can identify where the market is most likely to continue, you know where the market shouldn't go. And it shouldn't go beyond that window of opportunity. It shouldn't go beyond that window, beyond those triggers. And if it does, you've lost your advantage. Your edge is gone. And because your edge is gone, you're no longer looking for that trade. And you're going to have a willingness, once you learn to trust this methodology a little bit, you're going to have a willingness to just let it hit, to hit that stop, to exit, and to get out of that trade. And I'm going to tell you right now that anything that wins 70 to 80% of the time, guys, anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. And what you're going to do is you're going to begin to develop trust. You're going to begin to develop so much trust in the idea that this simple process yields such great results that you're going to be okay taking that loss from time to time. But the great thing is more often than not, you're going to get a reversal bar in the direction of the trade. More often than not, that market is going to head in the direction of the trend, in the direction of the momentum, in the direction where there's nothing present to create a bounce. Um, and what you're going to do is you're going to limit your risk even further behind it. You're going to go 2 ticks above a reversal bar for a short, 2 ticks below a reversal bar for a long. And it's not uncommon for Nexgen users, even on the trades that don't work, even when we have that little cost of doing business, to lose $40 or $50 instead of $400 or $500, right? To lose less money, to minimize the losses, because if it doesn't work, it's such a small part. It's such a small loss right there. And the goal is that you guys can kind of go through this, that you can recognize on the large chart and speak to yourself in terms of advantages. I do, in fact, have the advantage of momentum because the smalls are below the large, or because the smalls are above the large. And I do have a clear path because price has not reached that next area, because price hasn't made it to Fibonacci support yet. And because the rules are met on the large chart, you're going to get comfortable turning your attention to the small chart. You're going to say to yourself, I need a reversal bar. I need a reversal bar to signal the beginning of a pullback. And once I get this reversal bar, I'm going to look for triggers. But I'm not going to commit to entering at triggers. I'm going to find the areas within them. And those areas within them, fibs, midbands, yellow 1-to-1s, are going to give the market something solid to bounce off of. And I'm going to be so comfortable and confident with this look that I'm going to activate a limit order just below that window of opportunity, or I'm going to activate a limit order just above that window of opportunity, and I'm going to wait for the market to come to me. And if it does, I'll be in a trade. If the market returns and hits my limit order, well, then I'm long or I'm short. But the cool thing is I'm short with odds favorable momentum, and I'm short with a clear path, and I'm short having come from the area where the market is most likely to continue. And guys, I'm going to tell you right now, if you focus 20 days, 20 trading days on being able to recognize where the market is most likely to continue, 20 trading days, being able, good morning, Miss Cindy, to identify momentum, to recognize termination conditions, 20 days focused only on pinpointing where the market is likely to continue, you're going to be a chart reader, guys. And I'm going to give you the keys to the kingdom here, the fastest way to get there. Chart reading 101. I'm about to drop a lot of stuff in the room. In order to get to where you want to be, you have to be able to recognize these patterns quickly because the market's moving. It's easier to see it when the market isn't moving, which means that the easiest way to go back and really commit odds favorable momentum to memory is to open up your large chart. Don't worry about taking trades, guys. Take pictures. And take this picture and draw a big old arrow and use your call out and say smalls below the large. Both are wide. Space between means odds favorable momentum. Strong triggers. Rule 1 met. And if you go through the process of taking this picture, if you upload it to Screencast, if you go to the 101 section in your spreadsheet and you drop that link in there and you go do strong down, well, what you're doing is you're creating recognition through repetition. You're associating a look, you're associating a pattern with an advantage. And you could do the same thing here for termination conditions, right? And you could do the same thing for that 50-50 look. And you could do the same thing for 1, 2, 3 divergences in the same place. And you can go through, you can do it for weak triggers. And if you go through and take these pictures, if you annotate these charts, guys, you're going to become a chart reader. But don't just take pictures, drop them in there. Take pictures, and talk about why there's strong triggers, why it's a termination condition. What is the advantage of this termination or of these strong triggers? What is the disadvantage of trading into a termination condition? And use the language and get in the habit of putting yourself in a position to associate a look with a rule and a rule with an advantage. And what happens is every time you look at your charts, you're going to speak to yourself and you're going to say, hey, look, my smalls are beginning to break above my large. I'm coming off of a fib, but I'm trading directly into a fib with all of the triggers below it. So while momentum is growing, I don't have a clear path, and my best course of action is to sit on my hands and do nothing. But when I do have odds favorable momentum, and I'm coming from that termination condition, and guys, this isn't a high probability, but notice how even the pattern happens. The market comes right back, right to resistance inside of favorable large triggers, and that's what gives it the next push down, right up until we get those divergences right off of a fib, not a clear path. So create recognition, guys. Do this for each individual picture. By the end of the pictures, and it's approximately, what is that? 165 pictures. This is about 4 hours of your life to become a chart reader. There's a few of you in the room that are doing it. There's people that have done this, and they tell me time and time again that it's creating huge advantages in their ability to read the charts. I would encourage you as a new user to go through this process. As you learn to trade the software, I'm going to give you a plan. I'm going to give you a plan designed to optimize your chances of success with that high probability trend trade, with that 50-50 trade. This is only a stepping stone in your journey, ladies and gentlemen. This is not the end. And what you're going to find is that your ability to read charts is going to open a million doors for you. And you're going to see all these other patterns and all these wonderful opportunities in the market. But in the beginning, keeping it simple, it helps you find success. And success breeds confidence. So through simulation, study, class feedback, continuous practice, you're going to create a plan tailored to your personal goals based on your experience reading the indicators. Guys, that's nothing more than AI-generated shenanigans that say once you're a chart reader, you're going to see tons, and you're going to see tons of opportunities, and you're going to create your trading plan. The simple plan for the brand new user is don't fight the large chart and define your entry. The easiest thing. Don't fight the momentum on the large chart. Don't break that rule number 2 and trade into areas on the large chart. This will eliminate 60 to 70% of the typical new user mistakes. And I know this because I've been a new user, guys. These are the mistakes that I did over and over. So define your entry. And from this KISS plan, it's going to show you if you have a termination that reverses the market, if you have an area that stopped the market, no triggers through, reversed it, you were going to call that a strong top or a strong bottom. There's pictures of both. And this is the precursor for the highest probability. You're going to make sure that you have strong triggers. You're going to make sure that there's nothing in the way, and you're going to make sure that you're pinpointing your entry, guys. Once you can go through this process, I've never had anybody in the history of this checklist do worse than 70%. So I'm going to give you this checklist that you can print out and put on your desktop and police yourself every time you take a trade. And then for you new users, I'm going to give you the same checklist again with what does it mean to have a good top or bottom. Here it is visually. It's a termination that reverses the market. And this is odds favorable momentum, and so is this. But this is the opposite. So you could even use this as you take pictures to make sure that you're taking the correct pictures, labeling it. Termination, potential to break, area broken, window of opportunity to the short side, window of opportunity to the long side. All of these things are going to come together to create the high probability trend trade, the trade that typically wins 70 to 80% of the time, the trade that creates confidence through the memory of success, the trade that teaches you to become a chart reader. And then once you've got that, it's going to open the doors for more things. And once you are a chart reader, you're going to have to manage it. Once you can get in at the right spot, you're going to have to do something with that great entry. In the spreadsheet, I'll show you where I'm taking it from. Under management, I have what is the most basic form of management for new users. It is going to be the most pragmatic. It's going to be opinionless. It's going to be nothing more than if-then. And the same way you're using that approach to enter the market, this is going to allow you to remove the emotion, to keep it rules-based as you learn to manage the market, manage your great entries. And what happens is that you will create a plan. You will create a management plan based on your ability to read the indicators. But the thing is until you can read your indicators, management, it's the more difficult of the two parts because all that emotion comes in. So this is designed to keep it very, very emotionless, to keep it very if-then, and everything on your very mechanical management plan is 100% dependent on your ability to enter where the market is most likely to continue. So once you define that entry, once you understand where the market is most likely to continue, once you can identify that window of opportunity, what you're able to do is you're able to say, well, this is where the market shouldn't go. And because the market shouldn't go here, this is going to be my initial stop. And because this is my initial stop, I'm going to learn to be brave. I'm going to learn to trust this methodology. I'm going to learn to believe in this pattern. And these guys are going to have to come get me. These guys can't, I'm not going to put a stop just above it, hoping they don't get it. I'm not going to put it below resistance inside of favorable large triggers, hoping that they don't push up. Guys, that's what we call chumming the water. You're going to say, my stop is outside of the window of opportunity. My stop is where the market shouldn't go. My stop is right there. And if they really want to stop me out, that's where they have to come get it. But the cool thing is you have the advantage of momentum and you have a clear path, right? And more often than not, you're going to get a reversal bar in the direction of the trend. And once you get a reversal bar in the direction of the trend, sorry, let me make that fit. You're going to reduce your risk. This is your next stop. Your next stop says, if the market gives me a reversal bar, then I will move my stop 2 ticks above that reversal bar, or for a long trade, 2 ticks below that reversal bar. And then once again, there's just nothing for you to do. You're sitting on your hands, you're doing nothing, and the market is going to have to come and get you. They're going to have to show up and hit your stop to take you out of the market because you have every advantage at this point. And if they don't hit your stop, well, then they're probably going to hit your first target. For the KISS plan user, for the brand new user, this target is $100. It's only $100, and that doesn't feel like a lot until you realize that if the best you can do is hit $100 3 times in a row, that's a $300 day, right? That's like a $72,000 year. You're going to hit the first target. It's going to close your first contract. That's going to go into your account. They don't take that back. And you're going to move your stop to break even. And this is going to create trust, guys. This is going to create trust in the idea that the only reason you're in that short trade, the only reason you got in where the market was most likely to continue was because of odds favorable momentum, because of a clear path, because there was no reason for this market to stop and bounce. And you're going to hold. That break-even stop's going to make it easier to hold for the second target. And if all that momentum and a clear path carries you to the second target, well, now you have a trade that is complete, that is done. You're out of the market. And you're out of the market with a $300 winner. You had the highest probability entry. You had the advantage of momentum on the large chart, a market that was likely to continue in the direction of the trend. You had nothing in the way on the large chart that could create a bounce, no reaction points. You pinpointed exactly where the market was most likely to continue on a smaller, faster chart, and you eliminated the emotion by having a very, very mechanical approach to management. And guys, this is the easiest way to learn how to read your indicators. This is the easiest way to build confidence in these advantages. This is the easiest way to create recognition. And this is your highest chance of success as a new user. But I'm going to tell you, we all get bored. We all see other people holding for bigger moves. We all get that little green-eyed monster. Guys, your ability to read charts, your ability to recognize advantages is what's going to grow your plan. And your plan is going to blossom from this high probability trend trade into that medium probability trade. We'll talk about it. Your ability to recognize advantages on the large chart is going to help you hold for bigger moves. And you're really at this starting point. as a brand new user, and I want you to not focus on the wins or losses. I don't want you to focus on the end result of what you're doing as a new user. I want you to focus on speaking to yourself in terms of advantages, saying to yourself, I do have the advantage of momentum, and there is a clear path, and I've identified my entry area. And what you'll find is that the process tends to yield the results. The process is what carries you over to finding more, seeing more. And the more pictures you take, guys, the more you fill out this spreadsheet, the more you come back and study it every day. Come back and study your spreadsheet. Come back and study your trades. This is what I did. This is how it worked. This didn't work. This is how I felt. You're going to set yourself up for success. You're going to find yourself in a position where you can just do more and more in the market. You'll see more and more. You'll be able to react faster. You'll be able to recognize quicker. And ultimately, you'll get to this point where it almost becomes easy, effortless to find your trades. So once again, I'm going to give you guys the KISS trading plan. I'm going to give you a copy of my spreadsheet. I'm going to give you that chart reading 101. And I'm going to remind you that your results will be dependent on your desire to find them, on your ability to do the work, to get in, to recognize these patterns, to really focus on giving yourself these advantages. Are there any questions about the high probability trend trade? Are there any questions about momentum? Are there any questions about termination conditions? Are there any questions about anything, really? Because we're about to get into the day where we start looking at your charts. And guys, I've got 7 charts today because it's a slow Monday. And we're going to talk about your charts, and we're going to go back to advantages on every chart. We're going to talk about what we see. Thank you for that, Kenny. Guys, these are the questions that make things happen. We were going to talk about this on your chart, actually. So I'm going to save that lesson. I want all of you guys to stand up, go stretch your legs, take 5 minutes. I'm going to do the same. But yeah, Kenny, I've got it written on a piece of paper. We're going to talk about that pivot stop out. We're also going to talk about where we find these strong tops and bottoms, and we're going to turn that into a whole lesson. And it looks like we're going to have time today. So thank you for posting that one earlier. And what you guys will find, for those of you that are still a little shy to post, is it's your posts. It's the things that you ask that turn into these amazing lessons. So I'm going to go take 5 minutes, guys. When I come back, we're going to get into more chart reading. We're going to get into reading your charts. We're going to look at the live market. Hopefully NinjaTrader stops messing with me. I've done everything that I know how to do to make this thing work right. I think I need a full clean out. So I will be back in 5, guys. Talk amongst yourselves. Post them if you got them. All right, guys, we're going to get back into it while my charts reload here. And I'm going to start at the beginning of the day. We're going to go through and look at the charts that you guys have posted. Let me figure out where we're at. And we'll just start clicking. And Paul was doing some replay. And man, I love this. And I want you to notice how Paul annotates his charts, because this is a big deal. Odds favorable momentum. He's asking himself, do I have this advantage? And the advantage is clearly there. Yes. Clear path? Not quite. Not quite clear. The large triggers are close, but not quite. And then Paul says, and look how it pulls right back to resistance. Right inside of those triggers. And it's an easy winner. It's an easy one for him there. And then the next picture is that same level of ease. When everything is strong, right? When the market has that best look of momentum, down it comes. And you're absolutely right, it's a weak top. And then there's your pullback, straight to resistance, right at those triggers. And that's the one that goes down. And Paul, these are the trades that become effortless. These are the trades that really, if you learn to wait for when everything is great, things just kind of come into place, and it's nice. And then Kenny, we've got you, and I think you had 4 pictures here. I only thought it was 2, so let's take a look. Sim mode, strong top. So why is it a strong top? It's a strong top because it is a no triggers through termination condition. That termination condition reverses the market. Guys, that is a strong top. Perfect. It is odds favorable momentum. It is without a doubt a clear path. There's nothing in the way. And it is the perfect entry inside of favorable large triggers. All right, Kenny, you have annotated it with every advantage that we look for, right? You have identified odds favorable momentum, a clear path, and an entry area. You got in at the best of the best spot, and it didn't work. And I think that this is probably one of the most important pictures that you guys can take. And this is one of the biggest reasons that annotation is key. And Kenny, when you took this loser, were you mad? Did you start searching for what you did wrong? That was always my thing. I was mad, and I would start searching for man, what did I do wrong? What didn't I see? And I start making stuff up, Kenny. This is what I did. I'm like, well, maybe it was because this yellow 1-to-1 wasn't doing, or maybe I was too close to support, or maybe it had something to do with happened 3 days ago that pissed people off, right? And the reality is, and this is one of the best lessons that you can ever get, is that we trade patterns, right? The high probability trend trade is a pattern. It gives us momentum, which is easily defined, easy to recognize. It gives us a clear path. Once again, the lesson is very simple, and it gives us an entry. In the high probability trend trade, the absolute best of the best trade is a 70 to 80% winner. So what happens, Kenny, and you did it beautifully, is you use the language, you talk about the advantages, you took it at the absolute perfect spot, and it didn't work. And you've got to go look at these trades and not think about one trade. This is a cost of doing business, right? This is a normal part of trading. And the key is that you focus on the execution of the rules and not the result. And that is like the worst spelling ever. Focus on the execution of the rules and not the result. And what happens is you go back and you get to this point where you're like, man, if I take 10 of these, 3 of them are probably going to lose. It's just a part of it. And because 3 of them are going to lose, there's no reason for me to create an emotional attachment to losers. There's no reason for me to get upset, to get mad, to stomp my feet, to try to revenge trade. Because if I can honestly say that the rules were met, then I know that I have a statistical advantage. And this is the trade that I have to take every time, because this is the trade that if I take 100 of them, I'm going to win 70 to 80. And that 20 to 30 is like paying rent on your business. Does that make sense, Kenny? So I love it when you guys annotate the charts. And I can tell you right now that the more trust you build in this methodology, the more times you see it, the more likely you are to not sweat these losses, to not feel bad about these losses, to not get beat up and be like, oh, this is so rough. So let's check it out. Nope. And it, dude, that's a real part of it. And this is one of the great things about this class, I think, to be honest with you, is I really believe that when you post in the room and we have these conversations, sometimes having somebody tell you, hey, you did everything right, this is just one of those ones that didn't work, then it makes it easier for you. It makes it easier to accept. So let's go through the difference between a divergence and a pivot stop out, right? And this was the one that led to it. But before we do that, Kenny, let's talk about this. Did you have momentum? Absolutely. Let me see something. Triggers rolled through the one-to-ones. Okay. So here you define your clear path. Did you notice that? That here you talked about the triggers got to the other side of trouble, letting you know that it was a clear path. And here you somehow left that out. You somehow omitted the idea that a clear path was necessary on this trade. And this is another reason that annotation is huge, because you begin to recognize the things that you're willing to ignore so you can take a trade. You're good with termination conditions. I know you are, because your last chart showed me that you understood that you have to get the triggers to the other side. What do you suppose the first problem was with this trade? Probably directly into an area, and all the triggers remained above. And that's textbook, and I took a picture of it so that we could come back and talk about it. Is this was textbook termination condition, 100% not a clear path, which means, but it already hit it. And thank you for saying that. It already hit it, right? If you drive your car into a brick wall and it bounces back 5 feet, you don't get on the accelerator again and try to get to the other side of that wall. But this is it. Once you hit this area, man, that's a termination condition, because decisions are being made. So right here, what happens is either every seller just jumped ship or every buyer was waiting for that blue fib to push it up. So you reach the decision-making point. Does that make sense? And this is the brand new user, the blanket rule. Once price reaches, then you have to wait for it to break. It will remain a termination condition indefinitely. Cool. And then the other side of that is we can go through creating a little expectation as you begin to grow with the software. If this was coming from what we call a strong top, if this was a no triggers through termination condition that reversed the market, then the likelihood of this breaking goes up. But since it didn't, there's no expectation. And the other thing is rule number 3. Do you remember when we talked about the correction point, where we expect price to return on these pullbacks? That these moving averages clearly define where we expect price to go. And man, once you get those split triggers and you knew it, notice that your mid band is in between in little trigger purgatory there. So the termination condition was bad. The idea that these were split was even worse. And those very simple rules, that very simple idea of the high probability trend trade gives you an advantage. And what happens And let me do this because this is one of my favorite things to do. And I think that if everybody builds one of these and puts it on their desktop, you're going to be pretty cool with everything. So the first one is I gave away a clear path, right? So I'm down to 66% of my advantages. Well, I also gave away the entry area with those split triggers and no areas inside. So I'm kind of relying on nothing more than momentum to produce a winner. And sometimes that's all it takes. But typically, momentum is only enough when there's nothing in the way. So I find that if you speak to yourself in terms of advantages, then you also have this conversation with yourself. Am I willing to risk my money on only 33% of my advantages? And I know that it probably sounds silly, but that is such a real thing. And if you start talking to yourself like that, if you start saying to yourself, man, I'm giving a lot away. Maybe this isn't my trade. Maybe this isn't the best of the best. Maybe it's okay to sit on my hands and do nothing. And then you piece it all together. And then this awesome conversation about when it hits it, we got to let it break, sets you up to be a little better next time. And now we'll also talk about the difference between a divergence and a pivot stop out. And let me see. And I created this for it. So I'll drop this in the room too. And hopefully this is helpful for you guys. And this is a pretty big misunderstood concept. So when we talk about a pivot versus a pivot stop out, a pivot is just a spot where the market has changed direction. That's all a pivot is up, down, down, up. And then if the market loses momentum, if the momentum of the market doesn't follow price, there's a disagreement between price and momentum, and this is called divergence. And it simply means a loss of momentum. Don't give it any more value beyond that. So if there's a loss of momentum at a pivot, you'll see a magenta line from a high, and you'll see a cyan line from the low. And all it is a loss of momentum. It's not a catastrophic failure. It's not a guarantee of reversal. It's just a loss of momentum. And then scroll down. But when price returns to that divergence high or low, and then it trades beyond it and then changes direction, that's when you have a pivot stop out. And you'll see it annotated in class as a PSO. And man, this is a termination condition. And no more long trades should be taken into a pivot stop out at a high. And no more short trades should be taken into a pivot stop out at a low. So you kind of go through this little process. The market pivots all the time. Sometimes it has a loss of momentum, sometimes it doesn't. If it has a loss of momentum, you'll see the line. And guys, these are the same lines that we use for termination conditions. If price reaches that divergence high, the triggers remain below, it's a termination. But the pivot stop out is a very distinct look, and it takes the price returning to that divergence high and then trading back below. Does that help a little bit, Kenny? So this is just a pivot with a loss of momentum. And since it's not a termination condition, this support in midband is even more likely to hold, because what you'll find a lot is when the market pivots from nowhere, even with a loss of momentum, a lot of the times it likes to continue up. It likes to continue in that direction. So great pictures so far. A lot of good lessons going on here. And then let's go to the next picture and see what it is. Second stab at it. Divergence. Again, reverses trend. Divergence does not reverse the trend. It's just a loss of momentum at a pivot. And then let's see where you got in. Directly into a termination condition once again. This is where trading becomes frustrating, Kenny. This is where 90% of your day is spent waiting. Notice how price reaches support, the triggers remain above, and it kills your short. Price reaches support, triggers remain above, and it kills your short again. So what's kind of cool is that now we're recognizing your thing. And I know that it's your thing because your thing was my thing. Does that make sense, Kenny? Do you see how you traded into a fib? Once again, yep. Dude, I was notorious for this, Kenny. And what I did, this is how I fixed it. And once again, your entry is 100% in the right spot if that fib wasn't there. How I fixed it, Kenny, and I had to have my brother tell me the same thing. My brother's like, dude, Mark, how many times are you going to trade into an area and hope it breaks? So when I started looking for a trade, I had it in my head. The first thing I have to do, the second I look at a large chart, is I would ask myself, did price reach an area? And sometimes I would even just circle the top of the bar and see if there was a line there. Because, man, I was notorious for trading into these areas. Um, and then divergence from a fib makes it even worse. And the two divergences from a fib makes it even worse. This is pretty much saying, yeah, I don't think we want to go down anymore. I think we want to go up now. Great pictures, though, man. And yeah, the brick wall analogy. Most of the analogies that I give you guys are the same things my brother said to me when he was trying to get me to stop trading into these areas. Now we have the pivot stop out here, right? That's that perfect pivot stop out. And that perfect pivot stop out creates a reversal. It's a strong bottom. And that strong bottom gives me momentum. And look at your entry. And that's the easy one, Kenny. Wouldn't you agree? That's the one. I bet when it hit, it didn't take long for it to get up to your targets. Because the termination reverse, that's a strong bottom. That's your great identification of a pivot stop out. Smalls outside of the large, clear path, perfect entry, just beautiful. These are the easy ones, man. These are the ones that take a while to get to. These are the ones that man, when they happen, they're great. These are the ones that you really start to trust the ideas of all the different things when you see them come together. So great one here. Beautiful one here. All right, let's see who's next. Paul, we've got you here. And now we're talking about, and great lesson, Paul. You were asking about the PSO. And I reminded you, and this is for everybody, strong tops or bottoms. Strong tops and bottoms are a large chart thing, guys. Strong tops and bottoms are, there we go. Strong tops and bottoms for the new user. Guys, I'm making all of these little blog things for you. So when you're learning termination conditions, the recipe is always an easy one, right? If the price bars reach the area, the trigger lines are above support, below resistance, you have an area likely to stop the market. Exhibit A. Guys, if this no triggers through termination reverses the market, those large triggers go from green to red, we're going to call it a strong top. So Kenny, this kind of compounds on what you showed me. If I have a strong top, if I have a termination, none of the triggers break through, and it reverses the market and gives me that level of momentum, that's when these areas are more likely to break. Not guaranteed to break, but that's where the advantage goes up. That's where these 50-50 trades are more likely to work. That's where these fibs are less likely to hold, because you had a decision-making process that created this. I mean, here they said, the seller said, hey, we're taking your momentum. And when the buyers came back up, they get that pivot stop out. None of the triggers break. Look how weak the triggers are. This is pretty much the sellers putting up a middle finger and saying, yeah, no more, we're not going. And sure enough, it pushes down. So let me go read everything that you had there, Paul. And Paul, do you understand how that's a strong top? Because it is a termination that reverses the market. And the post you put in was an overrun on the 5-1 fib resistance that turned the market with a PSO. You gave it a weak rating since it overran the fib. Man, when you guys talk in the room, the lessons get better. So, and I think for that one, Paul, just remembering that if I'm looking for a strong top or bottom, that's the only chart I need. I don't even worry about the small chart. To hell with the small chart. Small chart's an entry chart. That's where it happens. And there's so much information on this chart. That's a pivot stop out. When it reverses the market, it's a strong top. That's odds favorable momentum. And guys, even with the strong top, guess what? That's a termination condition. How many lessons can you get from a picture that's doing absolutely nothing? Great picture, Paul. Great question. And hopefully that clears it up a little bit for you. And you guys are going to see these strong tops and bottoms. You're going to see them reverse the market, and you're going to start to develop this trust in the power that it creates for what happens after. And then when that strong top, you do get a 50-50, right? Small's below, larger not. And then let's read what you wrote real quick. Strong top. Strong top will usually not have a bounce at the 13.2 fib. 50-50, odds favorable, not clear. And it just becomes problematic. Entered as third divergence, posted, exited. One of the things for me, Paul, and I'm not going to tell you how to trade at all. That's not my job, right? But let's talk about this medium probability trade, this 50-50, if we can for a moment. And I'm going to go straight to the KISS plan, and I want to talk about everything that's on this KISS plan about taking these trades. If there's anyone unclear on what it means to have a 50-50, it means that an area is not broken. It means that it has the potential to break. Come on, picture. The area has the potential to break because of the momentum. The small triggers are through, the large triggers are not. That's the 50-50. So when you go to the KISS plan, the first thing and the most important thing, I think, is from a good top or bottom. Is the market coming from a strong top or bottom? Is it coming from an area that reversed the market? Did a termination condition with no triggers through reverse that market? And let's do this. Let's take your picture and let's just put this checklist right on it. Dun, dun, dun. Not a lot of pictures, guys, so I'm in no hurries today. So we're going to come through with your picture, and I'm going to drop the checklist on it. And we're going to do this not to say shame on you or anything like that. We're going to do this because we're just going to talk about advantages. So is the market coming from a strong top or bottom? Is it coming from an area, a no triggers through termination condition that reverses the market? That's yes. What does that mean? That means that decisions were made. Decisions were made right at this key area, and they were so strong that they reversed the market, that they provided momentum, that they set you up for this trade. And man, that is huge. Odds favorable momentum is huge. I love it. Small's outside of the large. Guys, remember when I said momentum is the same on both charts? Paul, you absolutely nailed the first three on this one. And so far, this seems to be lining up for a beautiful, beautiful, beautiful 50-50 trade. And we get the divergence here. And this is a little bit of a red flag. Because do you notice that that divergence is coming from the fib that I hope breaks? So there's already been a visual slowdown right at the fib, coming from the fib. And you let it break down. And then we get another divergence. And this divergence says, ooh, man, it's things are slowing. Here we go. And that's a no. Divergence is always a no. And divergence is the number one killer of 50-50 trades. But because of your strong top, I can see taking a chance on this one. Are you with me so far, Paul? Because of the strong top, this is where I might say, as a chart reader, I'm willing to let one slide. I'm willing to let one go because, man, decisions were made and I know the strength associated with that. And then, Paul, this was your entry, brother. That was your entry. Your entry was from the area right there at the triggers with the strong triggers. And this is a huge lesson on trust. Because when you know exactly what you're looking for, and I don't know if this was market replay or if this was live or whatever, when you know exactly what you're looking for, you don't hesitate. You don't hesitate on that entry. And from that entry down to here, I would wager was at least $100. because it looks like you got in around 70-ish, or you got in at 60, so that's probably 65. Let's see if I can line up some price bars here. The correct entry was around 72, and it made it all the way down to 59, $130 worth of profit, right? So you take that $100 on the medium probability, you go break even, and then you're up money, Paul. And that's where trust, understanding your plan, knowing exactly what it takes to get in, and more importantly, getting in at the right spot. Because when an area only has the potential to break, the more ricochets, the more bounces it has, the less likely it is. And this gives you an awesome management opportunity by getting it at the right spot. Other than that, I think the read is great. But you've got to take the correct entry. And then it lets you know when that next divergence prints that you got a GTFO. Beautiful large chart read. I think a little hesitation on your entry cost you on this one. Does that make sense? And I think that on a high probability trend trade, the success rate of getting in late is definitely going to be higher, because remember that decisions are made at key areas, right? Decisions are made right at this fib, and you can see, and I think this is amazing, and is that the sellers pushed right through the fib, and the buyers pushed back right through the fib, and the sellers pushed, and the buyers pushed, and the sellers pushed, and the buyers pushed. And all of this is a fight. Every bit of this is a fight right at that key area. And these divergences really give you an indication that things are starting to go wrong. But once your triggers get below, you take that best, and then that divergence says that the fight's still going. I think your large chart was spot on. I think your large chart was perfect. And I think just that little hesitation, because it was a 50-50, took away a little bit of the advantage. And it's always more manageable when you're getting in at the first at the best. Great job. And then Paul, termination, full reversal, 50-50. You got in momentum, and when you get in momentum, you get the quick profit. You're welcome, Paul. And this is such a cool thing. So guys, a lot of you are taking these momentum trades, right? This anticipating a breakout trade. And Paul gets in, and Paul knows that it's not a home run. Cindy, I think you're a couple days ahead. That's on Wednesdays. Your weekend was so good, you lost 2 days. Nice job. Way to Miami it up. Crude oil news will be on Wednesday. We're going to break Paul's down a little bit. And you guys will just have to believe me when I say Paul has odds favorable momentum on 3 charts. If you're going to take a momentum style trade, odds favorable momentum on 3 charts is the highest chance of success. Paul lets it break through and snap back, and this becomes his entry. And guys, momentum trades are just that. They're momentum trades. 100% based off of momentum. Paul takes quick profits because he knows it's just momentum, and the market goes up and down. And this is what I love, is Paul exits break even. Once he takes profits, he's break even. So I don't know for sure, but on a momentum trade, which has a short lifespan, Paul gets paid $100. And Paul understands fully that a momentum trade that's going to continue in the direction of all the advantages typically turns into a trend trade. Paul also understands, guys, this is just chart reading 101, when there's 2 divergences against a trade, very often it creates a pivot stop out above it. Paul utilizes the pivot stop out and the area inside of favorable large triggers to absolutely capitalize. And he's up $170 and already paid and 0 risk on the trade as he gets into the trouble spot. Beautiful trade, Paul. And guys, this is taking a medium probability scenario Trading it, hold on, where is my, there we go. Momentum in, momentum out. When momentum trades fail, he understands that it may turn into a trend trade. And he's capitalizing, and he's getting paid twice in the same area. So, Paul, I don't know if you're listening, but really well done on that one. All right, Miss Cindy, termination condition, no more longs. And it's weak triggers at a termination condition, which says this market's likely to reverse. Strong triggers, absolutely. And trading into an area. Trading into an area with the potential to break. So Kenny, are you with me? Cindy said, Mark, I heard you talking to Kenny. Let me give you the lesson. When a termination condition reverses the market, these areas are more likely to break. And I want to say that we said that, right? When a termination reverses the market, these areas are more likely to break. Cindy knows that. And with odds favorable momentum, she's able to pinpoint the perfect entry. And because there's divergence, she gets in at the higher end of the window. And with all this momentum, she gets paid on the way down. Cindy, I love this trade. But it begins with a termination that reverses the market, guys. When decisions are made at key areas, triggers can't break through. They start giving you rules met. Those are the trades that are more likely to win. Those are the trades that are more likely to push down and break areas. Is everybody good with that? Kenny, do you see the difference? Because I think this is just an awesome way to take advantage of what you posted earlier. Take a couple people's lessons and string them together. Creating expectations because of the strong top. I love it. And then, nope. Great question here, Kenny. Do you need to worry about this fib? Absolutely not. That fib is in your rear view mirror. It's not printing anymore. It's not active. That's the one. That's the one that if we reach it, that's the one that's problematic. Did you notice, though, Kenny, 3 divergences in the same price range? And if I'm not mistaken, that created a little push down. Isn't that awesome? I had a fib there, but I had 1, 2, 3, 4 divergences ultimately in the same price range. And that market's not going up anymore right off that termination. And Kenny, I've had so many problems today. I'm going to assume that your charts are probably right and mine are wrong. Don't freak out that we look different. And then great question. Is this area broken or did it stop the market because the triggers didn't make it through? These are my favorite questions because it allows me to go right back to the Sunday school answer. So we won't even worry about the small chart. We'll use this for annotation. If price reaches an area and the triggers remain completely above, below, it's a 100% textbook termination. And I'll tell you what, I'm going to put a 1 next to it because we're going to turn this picture into like an awesome lesson all the way across. So there's that example right there. If price reaches the area, no triggers break through, that's a 100% termination condition. The second one is if price reaches an area, the small triggers smash through with odds favorable momentum, it has the potential to break, but is not broken. Oops, and I forgot to put a 2 there. So what we have for number 2 is right here. where the smalls have broken through, but the large have not, which means that this area does in fact have the potential to break, but it's not broken yet. So not a clear path. So if we go back to our little slide ruler, maybe if you have the best of the best momentum in a beautiful entry area, Kenny, well, you might take a shot at this one. But let's see what the small chart looked like. Divergence kills a 50-50. Second higher divergence makes it even worse. That's the one that sent it rocketing up. What you think? Kind of cool, right? It would have been trading with an area that has the potential to break. Okay, so let's get some verbiage, right? 50% of my triggers have broken through, 50% have not. Are you comfortable with the 50-50 look? Okay, cool. So it's a 50-50 look. So what kills a 50-50 more often than not? Divergence. 100%. Divergence kills 50-50s more often than not. That's why when you go to the KISS plan, it says, dude, no divergence. And it says divergence, no trade. And it says if divergence prints exit trades. Divergence typically kills 50-50s. When it comes from a strong top, when it comes from a termination that reverses, well, then you can say to yourself, man, this has more chance of breaking. This has a higher potential of breaking. Maybe I will skip on the one divergence. This one time, I'll say, you know what, with one divergence, because of the good top, because of the momentum, because of the potential to break, I will take one shot from the area, right? And I'll get my stop in place. And then when you go to the management on the 50-50, I want you to see something. Your first target is the first trouble spot, which means that the fib that hasn't broken yet, that's your first trouble spot. Which means that you're hoping to make money from here to here. That's the first one. And then you're going break even. So you get a break even stop. Two divergences on a 50-50 is just financial suicide. So that's your let's get the hell out of the trade. This area is probably not going to break. Does that make sense? And it's a lot of chart reading. It's a lot of chart reading to not only take but manage these successful. There's a lot of things that you have to think about. You have to be very comfortable with identifying a strong top. You have to be very comfortable with understanding whether or not that's the best momentum or whether or not maybe it's kind of that janky weak momentum, right? You have to understand that these areas, that's three areas that aren't broken. This is one of the things I want you to see too. That's a divergence low that's not broken. That's Fibonacci support that's not broken. That's yellow 1-to-1s that's not broken. That's a big window. And if you look at that window, that is 6 points worth of not broken areas. That's a lot. And then this is also the NASDAQ. And NASDAQ demands a pretty high level of respect. So one divergence, I could get on board with it. Because it's the NASDAQ, your entry is really that down bar. And it doesn't give you a lot of room to get back with the problems. So great picture, man. Lot of great lessons in that one. Did I cover everything? I feel like we hit it. Cool. And guys, I love this stuff. I don't know if you do. These patterns repeat themselves all the time. I mean, these patterns all the time happen in the markets. And I'm telling you right now that if you go back and you study it, you're going to understand it. So pivot with divergence. What does that mean, Paul? Dude, you're on your way, Kenny. I'm telling you right now, I am the most stubborn, pig-headed, say the same thing over and over guy in the world. And you'll get there. It's just a pivot, right? Are we scared of this pivot? No. Is it a strong bottom? No. It's just a loss of momentum. To hell with that pivot. What does that tell me? Tells me that this 50-50 that just failed had a really good chance of failing. Awesome. Awesome, awesome, awesome. And I'm telling you guys right now, the easiest way to get to where you want to be is to go back and take pictures, right? Janky, not wonky. Why do I stress pictures so much? I'm going to show you guys. What lesson do you want to turn this picture into, guys? Do you want this to be a termination condition lesson? Do you want it to be a momentum lesson? Do you want it to be a pivot stop out lesson? Because I'm not taking any trades here. All I did is I took a picture of yesterday. So momentum, thank you for that. So I'm going to use a white arrow. And there we go right there. So if I have a white arrow pointing at it, then this is strong triggers. Why? Because smalls have separated. That's my hardest word to spell. I don't know why. Everybody has a word. That one's mine. From large, space between angled and wide in direction of trend. Does everybody see it? Separation, separation, separation. Do you notice that I didn't say there's a trade? I didn't say that it's time to go long. I didn't say that it's time to go short. I didn't say anything other than this is momentum. What is momentum? Momentum is only 1/3 of the equation. Is everybody good with that? So you take this picture, guys. Go put it in your spreadsheet. Put it under strong triggers. Here, watch. Let's do it together. Let's build that spreadsheet. But what I did is I annotated why it was momentum. And Rob, you're right, man. Triggers, dude. Triggers. Eventually you begin to believe it. All right, let's backspace. So this is a pivot. This pivot lost momentum. It is not a pivot stop out. I tried to. There's not a lot of pictures in the room today. When price exceeds a divergence line and trades back below it, it becomes a pivot stop out. Does that make sense, everybody? Just a pivot. Here it's a pivot stop out. Pretty cool, right? So let's take this one. And let's go to our spreadsheet and let's go to the client trades. And let's call this one pivot versus pivot stop out. And now we got it. Mark gives 90 minutes of lessons. Oh, not a lot on crude at the moment? Nope. Everybody's still hung over from Cinco de Mayo. All right, let's do it again, guys. This is one picture. I think that's enough. How about this? If price reaches an area and the triggers remain above support or below resistance, you have a termination condition. No clear path, rule 2 not met. Is everybody comfortable with that? Price reach resistance, the triggers remain below, no long trades. Price reach support, triggers above, no short trades. And guys, rule number 2 keeps you out of multiple losers. So now we come back and we go to our 101 section. And we'll call this one 5 terms. What other lessons can we get out of this one? What do you guys think? How about a simple one? Up, down. I'll see if I can get my crude oil to stay up. We'll take a look. But I mean, how many lessons can you get from one picture, guys? That's kind of what I'm trying to get here is everybody wants to trade to become better at becoming a trader. But the reality is that if you take these ideas, and you just kind of turn them into lessons, right? Go back, nothing's moving. What happens is it becomes easy to recognize it in the moment. It becomes easy to say, you know what? I've seen this pivot stop out 50 times. I know exactly what it looks like. And I'm not going to trade into it because I've seen it reverse the market more times than I care to mention. And you have to believe these very basic concepts, guys, and they all go back to 3 advantages. So when I talk about a high probability trend trade, it's 3 advantages. When I talk about the, oh, that didn't work. When I talk about the 50-50 trade, my knowledge of good tops and bottoms comes from the high probability trend trade. My understanding of momentum comes from the high probability trend trades. My ability to identify the window of opportunity comes from the high probability trend trade. When you talk about Paul's momentum trade, the understanding of momentum comes from the high probability trend trade. The idea of areas with the potential to break comes from the high probability trend trade. And guys, there's just so many lessons that you don't need to be trading to learn. And the more time you spend focusing on the looks, the quicker you're going to get to where you want to be. And that's what we say, the same thing every morning. What are the looks you're going to commit to, guys? What's it going to take to get you into the market? What's it going to take to make you feel comfortable risking your money? And then post in the room. Tell me everything. Tell me everything that you see. Tell me everything that you're wondering. Tell me everything that you're trying to figure out. And you tried to do it on your own. And man, I keep watching John Novak's videos, but I don't really understand this. And I keep watching Paul post in the room, but I don't really understand it. And guys, the only way that I can't help you, the only way that I can't get you where you need to be is if you refuse to post in the room. But I have this highly annoying trait where I don't forget a lot of stuff. So if you post in the room, I'm going to start to recognize your patterns. I'm going to start to recognize the things that you do over and over. All right, crude oil. Cisco. So I don't have momentum. My smalls are down, my large are up. I am all triggers above support and all triggers below resistance. In my high probability plan, I don't have anything setting up. Yeah, I'm user, but it's rare. I can't remember the last time I didn't have a trade. It's rare. And usually on days where I shouldn't have had a trade, I have 20 of them because I got bored and made up my own rules. So Cisco, I'm not sure what you're looking for. Head and shoulders long, right on. So you're going to say that a head and shoulders outweighs strong down triggers and a fib because you recognize a pattern in the market that stems from 3 pivots, the third higher, divergence on a failed 50-50, a second higher divergence, large triggers rolling, smalls above the large, and everything appearing to roll to the upside? This is why I love the software, guys. This is why I love the software, because Cisco sees this and he goes, man, I can't wait to go long. If you're a brand new user, you're sitting on your hands and you're just going, son of a bitch, I can't go long into resistance. Cisco has reasons based on patterns, right? The beginning of a setup. I know. I wanted to go from the very basic rule, Cisco, to what your chart read probably was. Things that I notice, and I don't ever tell you guys how to trade. I did have 3 divergences from a high, right? I do have a bad bottom. I have all my triggers below resistance after 3 divergences in the same price range. My small triggers are down, which means my immediate momentum is down. There's a lot of red flags for longs here. But the flip side is I don't know, man. This is where me personally, if my trading plan says I don't have a long because I won't trade against the small triggers on the large chart and into a termination condition, I don't know. It doesn't fit my rules. But the cool thing is it doesn't have to. It doesn't have to be Mark Novak's plan for you to take a trade. It can be your plan. And guys, I'm going to tell you right now, you're going to see things that I don't see. You're going to recognize patterns that I don't recognize. I will steal your patterns because some of you are brilliant, so much smarter than me. And I get excited about the idea that I can take your smart stuff in your chart reads and incorporate it into my plan every now and then. So good stuff, Cisco. We'll see. We'll come back to it, and we'll see how it works. Guys, I'm going to take 5 minutes, I guess. I'm going to go around, and I'm going to stretch my legs again and go pet my dog, and we'll get into the last hour. And the last hour is your hour, guys. The last hour is where I want to talk about what you want to talk about, where I want to talk about patterns that you need help understanding. I want to talk about concepts that you need a little clarity on. If you're working on a management plan, if you're working on an entry plan, if you're working on a whatever, share it in the room, guys. Let's talk about it. There are no wrong answers. That's the beauty of it, is there is no wrong way to trade the software. There's only your plan, and your plan should revolve around a statistical advantage. Your plan should revolve around patterns that you can go back and take 100 pictures of and say, out of this 100 pictures, I win more than I lose. I have a statistical advantage, and that's what we teach. And then you guys will branch out from those very basic teachings. So I'll be back in 5 minutes, guys. When I come back, we'll finish strong. You guys can watch this. We'll see which termination condition wins. Back in a few. Hey Siri, set a timer for 5 minutes. All right, guys, and I'm back, and I never wish anything but success for all of you. And this is one of those instances where, as a brand new user, you choose not to take this trade because it's into a termination condition, because the momentum isn't there. And as a brand new user, blanket rules are very much designed to keep you safe, to keep you on the winning side of things. There will be times where you will break outside of those rules. There will be times where your plan says that it's okay to trade into this termination because XYZ, but it should be repeatable, and it should be something that you can do over and over. And then, Andy, I don't disagree. When a pivot stop out can't move, and then there's some sort of fight going on, guys. And I don't know what's going on in the world. I haven't watched the news in months, but I do know that rule number 2 says don't go long. And the same thing is it also says don't go short here. So if I can't go long and I can't go short because my rules say so, well, then I kind of have to do nothing. Whoops, excuse me one second. I'm sorry. So kind of a cool lesson there, I think. And we'll look at the S&P and see what it's doing. Here's our large chart, and our large chart's still coming off of that termination condition. And this is one of the things that I think is pretty outstanding about the software, about what we do here, is I want you to see these two bars. It is all of these bars on the smaller, faster chart. And these 2 bars of information on the broad stroke of brush, it's all of these bars. And you're exactly right, Andy. Since 1010, this is all the market could do right at a key area, is just fight. And this kind of sets off just a great reminder that decisions are made, fights happen at key areas. You can see that fight on the smaller chart, even though the large chart maybe doesn't look that way. But we have our rules to keep us in line, right? Weak triggers says don't go long. Termination says don't go long. But it's not a short yet. We're not looking for a short yet. Your large triggers are flat. Your synthetics are still up. We're definitely not going long on the small chart, but we're only just now starting to get a little momentum to the downside, starting to get things to turn a little bit. So if this area is going to stop and reverse the market, these small triggers will roll. So what does this tell me? This tells me that there's not anything for me to do. I don't have any rules met. And one of the hardest things, guys, is to do absolutely nothing. And Muser, to go back to your question, this morning I had, my gosh, I must have sat for 2 hours and didn't take a trade. For 2 hours when the NASDAQ was stuck between areas. And I chose not to trade. And 2 hours it bounced off of fibs and was erratic. And for 2 hours I didn't lose a penny. And what a wonderful thing to not give any money away when the rules aren't met. So, and they're still fighting, aren't they? They're still trying to figure this out over on crude oil. And guys, I don't trade news, but there's all sorts of news going on right now. And maybe the markets are reacting. Maybe they're waiting. I don't worry about news in the market. I don't worry about what people say. Oil barrel reserves mean nothing to me. Wars in other countries can affect what the market does. So we're at this spot now where we have 2 markets with nothing to do. Let's open up a third market. We'll see what happens. All right. Daryl says, Mark, I'm going to keep you busy, brother. Don't you worry. Thank you for that. So let's see what we have, Daryl. You got a lot of charts. You have a 5-1, an 8 range. You do have a 13-2. And then what's this one? I'm assuming that's an even higher time frame. What's this one below it? Is that a 21? Okay, cool. So here's an interesting little thing, and you may not find it as interesting as I do, is I love letting a large chart lead the way. Right on. And I want to go through like some trickle-down economics, sort of, if you will, here. This chart, let me get my call out. This chart says odds favorable, momentum up, support to hold, right? Is that your read too? Odds favorable, support to hold. That's kind of the read there. And that's okay because this is a huge slow time frame. So we come down and there we get 3 divergences at resistance. We do get odds favorable momentum and that little split in the triggers. I don't know how RTY reacts, to be honest with you. I've never really traded it. Is overrun normal in RTY? Or does it typically follow rules pretty easy? Not as bad as NASDAQ? Okay. Your entry makes sense. Your stop makes sense. And they just had a little push to get you there. It's between the ES and the NASDAQ? All right. I mean, man, you had... And let's just go through it. These are the ones that are frustrating. But these are the ones that remind us that we're not in charge. You have an awesome 3 divergence, termination, reversal of the market, odds favorable, nothing in the way, perfect entry, and those mother scratchers got you. Daryl, I don't know that you could have done this any better. That's your 2-chart read, and your 2-chart read is freaking perfect. Everything is perfect. Everything makes sense. What do? You wait for the next best setup, or you say to yourself, this is such a good look. This is such a good look that even though they got me here, I'm going to get back in on that reversal bar. I'm willing to give it a second shot. Now my risk is established, right? I still have room to get to the fib. And now it's going in the direction that I want it to go. That's about the only thing. That opens a can of worms because if you take the wrong trade and you get in the habit of trying the wrong trade twice, well, then things go sideways fast. So I don't have a problem taking second entries, but my large chart can't change. My large chart can't change. Everything has to still be solid on the way down. And man, they just overran a little bit and got you, Daryl. So let's see if there's any context clues on the other charts. Your range chart doesn't give any indication that that trade would have been problematic. None whatsoever. Everything stayed down, odds favorable, 0 indication. The only thing that gives any hint of a problem is the 21. But the same way, and man, I'm telling you, I can't find anything wrong with this, Daryl. The same way, if this were a 50-50, I insist on this chart being perfect. This one is not perfect. Maybe I insist on this one being perfect. And it was. It doesn't get any better than that. So Yeah, this is very much all right. They got me. That's one for you guys. But I'm going to keep trading my patterns because my patterns win more than they lose. And it still did exactly what it was supposed to, right? And that might be a good second chance. It does happen. Once you realize that it does happen, it gets easier. So here's NASDAQ. What's NASDAQ been doing today? Guys, there's some struggles in the market. 50-50 from a pivot stop out. Divergences kill a 50-50, right? 1021, 50-50. Divergences kill a 50-50. One divergence, it pushes down, then the second divergence pushes up. I think we saw that one earlier. Guys, this market's struggling. It would appear that all the markets are struggling a little bit. So what do you do on a day when your patterns aren't showing up? What do you do on a day when things aren't working out? What do you do on a day when it looks like it's caught in between areas? Do you focus harder on the market and hope something happens? Shoot, go to Facebook. Man, guys, I'm on autopilot right now. I'm looking for a tea time. I'm going to go play golf. Actually, I probably won't. The weather's kind of nasty here, but I might go to a driving range or something. I might do market replay on a day that was flowing. I might say, check it out. None of my rules are met. Let's do one of those pictures again. This is the part that sucks for you new users, and I'm just going to say it like that because it is what it is. You're so excited with your new toy, right? You're so excited with the software. Guys, when the market isn't giving you rules met, this is the equivalent of getting a brand new remote control car for Christmas when you're 10 years old and your parents forgetting to buy batteries. And you're like, man, I have this amazing software and I can't trade yet. Not yet. My rules aren't met. So working, there's a pivot stop out. There's a perfect termination. There's the mid band working as a termination. There's a pivot stop out. Might have taken a loser there. There's weak triggers. There's a mid band with the large full bar away. There's a pivot stop out. There's a mid band holding. There's a termination. That might have been an opportunity. There's a 50-50 that failed. There's gap theory back to the triggers. There's a pivot stop out. There is divergence holding. There's a pivot stop out. There's divergence holding. Holy problems, Batman. Isn't that cool, though, that you can go through and you can start just, let me go through the lessons. That's odds favorable. 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 And you know, it's pretty neat. Maybe it's, I just think it's neat. But there was a tail there, and there was a tail there, and there was a tail there, and there was a tail there. So even though this has been riddled with challenges today, it looks like there's still opportunities if you just wait for the best of the best, if you just wait for things to be right. "50-50 failed. Man, termination for the win. Son of a gun. Sorry, Cisco. Did you ever get an entry? I might have, with that look, Cisco, with a reversal bar, taken a shot, maybe. I don't know what your plan says. Not on something like that. I don't trade head and shoulders. I'm learning. I'm actually doing a lot of studying, guys. With Nexgen's funding company opening up, one of the things that I'm going to be in charge of is adherence, rules, making sure that people are sticking to their plans and not breaking the rules. So I'm learning a lot about a lot, but it's crazy. From resistance to support. Is it going to go up or down? Large triggers are up, small triggers are down. Resistance is held, support is holding. I don't know, guys. Consult the Magic 8 Ball. What do you guys want to talk about? Rob, you say down? All right. So it doesn't concern you that the large triggers are still up? That all the triggers are 3 miles away from support? It may go down. I don't know. I could make a case for at least a retest to 86.50, 87, and then we'll see what happens. I could see the reason for down. Divergence, weak triggers, resistance holds, multiple divergences. I think for me, I would say the large chart says that down is a higher potential, but because of this, I'm going to be a little patient. Trigs went through. Nope, they're not through exactly. So definitely no longs. Might be too soon for shorts. It may pull up and close the gap to those large triggers. Hell, it might just bounce in between these two pretty lines for the next 36 hours. I don't know. I just don't feel like I have an advantage, right? I don't feel like I've got a clear advantage one way or the other. I don't have a clear path up or down. I don't have momentum up or down. And so all I'm doing is I'm talking to myself in terms of advantages. And Andy, what a frustrating second day in the room, right? The market is just having stuff. Guys, these are the days where study pays off. These are the days where we're doing a little bit of study pays off. Large triggers never rolled up, which means you never had momentum, which means that if you were adamant about a long, it didn't work out. And if you were thinking about a short, it's still into support. What do you guys want to talk about? This is where I start breaking into all of my Word documents that I have. You've had one trade with a loss of 2 ticks. You feel good about it? I would too. This has been a market that it's not trending, right? How can you take trend trades if there's not a trend? How can you take trend trades if it's not flowing one way or the other? And guys, this is where Paul and everybody, the better you get at chart reads, you may find opportunities inside of these consolidation areas. You may find patterns that allow you to get in at the trouble and trade down to the next trouble. But right now, I think that's a win. So let's talk about 6 signs that you're maturing as a trader. I like this one. Managing your risk before you ever manage where your hands are flattened. The SOH, right? The SOH, Muser. Guys, when you manage risk before you manage the reward, you may be maturing as a trader. Next-gen users have the ability to manage their risk through insisting on momentum and a clear path, by managing the risk, by waiting for pullbacks to areas, by utilizing a window of opportunity. So one of the things that I really try to make happen from the get-go for you guys is that focus on being a mature trader and creating those mature trader habits. Being completely relaxed when you're making trades, that is repetition. That is trust. It is, man. Large chart leads the way, Rob. I joked a while back that I was going to get coffee mugs with that written on it and sell to you guys from an Etsy store. Completely relaxed when you're making a trade. Why are you completely relaxed? Because you know you have a statistical advantage. When you know that this recipe creates a scenario that wins more than it loses, it's hard to get stressed about it, right? Kenny took the perfect trade earlier and it lost. And I think Kenny is like, okay, whatever. Daryl took the perfect trade and it didn't win today. And he's like, what are you going to do, right? Totally relaxed because they knew that he had a statistical advantage. And then when you don't force or chase trades, forcing, I think, is more detrimental than chasing because sometimes you have so many advantages that even a late entry is justified, but not trying to make something happen, right? Not trying to impose your will on the market, but rather going with the ebb and flow that the market creates. Not letting it be your adrenal fix for the day. This isn't your entertainment, right? This isn't a video game. This is an investment. This is your job. This is your business. And the same way for any investor, you would have to write a business plan on how you're going to operate. Trading is the same way, and you've got to follow that trading plan. And any business plan, I'm not sure how many of you have ever started businesses, but any business plan outlines the risk, it outlines the returns, it outlines the costs. All of these different things are clearly established. That's what your trading plan does. Um, and then because I'm a hippie, I keep this one in here. Is your worth as a trader and your worth as a person are two very separate things. Traders are the beating themselves uppest group of people I've ever met in my life. I've got 32 people in the room, and it's probably 32 people that believe that they should have been excelling at this inside of their first week. When the reality is it's brand new, guys. You're a student. You're in kindergarten. This is your freshman year of college. And you've got to take a little time and give yourself a little grace to be new, to make mistakes, to ask for help. So those are the signs you're maturing as a trader. Support is still holding. What else do I have for you guys? Perhaps, Paul. I'm much more touchy-feely than I used to be. Um, I used to just be a punch you in the mouth kind of guy. Now I'm a let's see if we can fix what's broken with you kind of guy. Guys, when you stop expecting to win every trade, you start winning most of your trades. And there's a lot of great stuff in this. I'm going to drop this one in here. This is from Mark Douglas, the late Mark Douglas. Brilliant on the psychology of trading. He and John Novak used to talk in the 90s a lot. But when you start focusing about the execution of the method, you stop fearing the result because the execution is based on a sample, a collection of 20 to 25 trades that have been proven to win more than they lose. Um, what is that? Is that what Mrs. Novak says? I don't remember what I said. That I'm a hippie? Or that she's trying to fix me. She's been trying to fix me for almost 28 years now. Hasn't worked yet. But the emotional pain of trading, guys, touchy feely, yeah. After dinner and a movie, maybe. Um, the emotional pain is self inflicted, and you create your own, and it's based on your experience with just the up and down ticks. When you decide that a trade should win, then you're more likely to have a negative emotional response when it doesn't. But when you accept that winners and losers are irrelevant, that the execution is the key. That trading a statistical advantage over and over, that's how you get to where you want to be. And Mark Douglas uses the example, if you weight a coin on a coin toss, then it's more likely to land on one side or the other. And it's not guaranteed to land on that side every time, but because you know that it's going to land on heads more often than tails, even if it's 70 out of 100, well, then you're going to bet heads every time because you know that there's this advantage, the likelihood that you're going to win more than you lose. And that's really one of the biggest things that you've got to get comfortable with as being a trader. That trades will lose, that it's a cost of doing business, that you are never in control of the market. You're just trading patterns that it creates. So something to think about. And then this one, I'm going through all the stuff that I have. The key to everything is a foundation, guys, creating a solid platform from which to grow. Your foundation is momentum, a clear path, and an entry area. So for you new guys, I blanket it. Um, Guys, clear path is imperative, and momentum is 100% mandatory. And Areas inside of favorable large triggers should never be omitted. And I do this because it's this blanket rule, guys. It's this confidence builder. It's this, how do I keep my new users safe, right? You guys are my flock. You are my sheep and I am your shepherd, and my job is to keep you out of harm's way. And by blanket rules, as you learn to read your indicators, I'm able to do that a lot when you follow those rules. But just like anything, the more time you spend with it, the more comfortable you get with the looks, the more confident you get with your chart reading, you'll understand when you can break rules a little bit. You'll understand when you can bend rules. You'll understand patterns that create advantages, that create exceptions. So don't be the trade police, right? Remember to focus on your plan. Focus on, thank you for that. Focus on what's good for you in the moment, right? Take care of yourself. It's like when you fly on an airplane, you've got to put that little air mask over your mouth before you try to help anybody else. Otherwise, you're going to pass out. You're going to be useless to everybody, and I'm going to have to put you over my shoulder, and my back is bad. So focus on you. Focus on your plan. One of my favorite pictures, what to expect, the experience curve. Everybody giggles when they see this, especially if they haven't seen it in a while. So this is for you newer people. Looks like fun. Hey, I got this. I saw this ad on Facebook, and it said I can be a day trader, and there's the potential for this money. And man, this looks like a blast. And I'm going to sign up for the demo because it's absolutely free, and I'm going to watch the classroom. And then about 3 days into the classroom, you're like, holy smoke. So Andy, this is where you're at. This feels like a lot. I've got to learn momentum and clear path and all this stuff. And you're like, gosh, but I keep seeing people winning and making money, and I know that it works. I'm going to keep doing it. And then you start going and you're doing great and you're confident, you're on simulator and life is good. And right around 30 days, you decide that you are Billy Badass and you are untouchable and you made some simulator money and it's good. And guys, this roadmap is the Mark Novak story. It's very autobiographical. And I went live too soon, but I didn't have the advantage of a funding company back then, guys. I put a lot of my own money into an account. And I lost 5 grand in about 2.5 hours. And I lost 5 grand in about 21 trades. And I didn't have the 5 grand to lose back then. And it was the biggest kick in the gut that I've ever taken in my life because I wasn't prepared. I thought that I was because I'd gotten lucky on simulator, but I'd never taken a picture. I had never used my spreadsheet, and I'd never posted in my brother's room and asked for help. And my brother was quick to point that out. And I got aggressively to the I don't know squat stage, and it happened fast. And I was mad at my brother, and I was mad at the market, and I was mad at indicators, and I was mad at Ninja Trader, and I was mad at everybody but myself, which is weird because the reality is I'm the only person in my life involved with my trading that didn't post in the room and ask for feedback. And I'm the only person in that series of losses that never used a spreadsheet. And I'm the only person that never asked for help. I just expected to be good. I felt entitled to be good. And I almost quit. I almost quit 100%. And I was angry, and I'd just come off of spine surgery. And I was just livid. And then I made a decision right here. And I said, you know what? I'm going to try it John Novak's way. He's been training people to do this for 20 plus years back then. And he must be good at it because I keep seeing people making money. I'm just not one of those people yet. And I started the process. I started over. I wasted about 3 months of my life to get to the start over point. And once I did, I followed the path and I hit all of these. This is making sense. And did I do that? And holy crap, I did it. And guys, this is real for so many people. And one of the biggest things that I try to do for you guys is I had to go through all of this. I had to go through each and every one of these steps because I'm arrogant, because I have a huge ego. So I teach this class with the assumption that I can start each and every one of you right here, that each and every person that comes to Nexgen can avoid all of this heartache if you just walk in the front door and you say, I don't know shit. What's the best path to get there? And then we just go through the path of least resistance together. So that's one of my favorite pictures too. And then Paul, 50-50. Strong triggers, 50-50, one divergence. Market is still choppy. If it will break out, look for a trade. So let's talk about two different things on this one. Man, Rob, there's hope for everybody. I was so convinced I was never going to get this. Man, I've got a giant scar that runs from my butt crack to my lower back from 2 spine fusions and a rebuild. And I was miserable on painkillers. It hurt to walk. It hurt to sit. It hurt to do everything. I had been fired from my job. I'm not. And I didn't know what I was going to do, man. I had absolutely no idea what I was going to do. But I'm also one of those people, guys. If you hand me a baseball bat when I hit a home run. Like, if you put me in school, I didn't have to study much. And it was just, I don't know, there's just those assholes that sometimes things seem like they come easy to you. And I was one of those guys in a lot of cases. I was not afraid of hard work. And I moved up at everything that I did, and that was just my personality, very, very alpha. And I got to trading, and it was one of the most humbling things in the world for me because I had to admit that I wasn't smart. Or not that I wasn't smart, that I wasn't trading smart. I wasn't Nexgen smart. I didn't understand these indicators, and I had to just step back a little bit and learn them. And then one of the lessons here, and I like this that you said, man, it's been choppy. I don't have to be first. The market's been caught in between areas. I don't have to be first. The market isn't breaking through these termination conditions. I don't have to be first. And Paul, there's two ways that these 50-50s from a consolidation work. You either get run over instantly or it runs forever because that's finally the breakout. And trying to be first, there's crude oil right there. Divergence, right? Trying to be first is rarely advantageous. Because they've already told you that their collective heads are wedged up their asses and nobody can make a decision whether they're going to break the terminations above or below. And guys, we just don't have to be first. We have the ability to sit on our hands and do nothing. So you might say to yourself, if I get everything above 78.90, I'll look for longs all day long. And if I get everything below 78.50, I'll look for shorts. And these 50-50s, when they try to break out, one of them's going to break out. One of those 50-50s, let's see if we can find it. One of those 50-50s is going to work. One of them's going to be the one that launches it. But if you go through crude, oh my gosh. Guys, this is crude. Termination, and they have been, this is May 2nd. Crude has been in a fight. Second mouse gets the cheese. Amen. Crude has been in a fight. Guys, look at that. That's 2 days worth of crude. Does that look like a trending market to anybody? Not so much. Stinks sometimes, right? Stinks sometimes. And they're doing it. And there's little spurts of greatness where you can get paid, but you've got to be on your game. And this is where rules keep a lot of us safe, guys. This is where rules keep a lot of us from forming opinions, getting into the market. This is where rules keep you from taking that short on hope or keep you from taking that long because you wished upon a star. And Rob, we're still caught, but they're pushing down, aren't they? Termination, weak triggers, divergence. They're trying to push. And you know what I liked about your assessment, Rob? and I want you to see this. Rob said we're more likely to go down. That means Rob believes in termination conditions. That means Rob believes in weak triggers at termination conditions. And Rob says with this look, we're at least more likely to get down to here. And we'll see what happens when we do. But man, that's cool. Because sometimes you don't realize that you're at this point. I think you realize you are. But guys, I've looked at the market and made decisions and didn't realize that that decision was coming from my ability to read charts. I didn't realize that that decision was coming from my understanding of these patterns. And you've got to be able to celebrate that. And this is one of the cool things that I like about the classroom as well, is I'm the celebration hippie. I come in and I remember what you guys have been doing. And we'll just talk about it. We'll celebrate it. We'll be happy about it. And man, to hell with crude. Guys, this is a great day to go to Sizzler and just hit the buffet. We've got about 33 minutes, 35 minutes, 25 minutes, whatever. That's it. It's the same thing, isn't it, Rob? I had someone send me a message once, and they're like, how the hell do you say the same thing every day? Don't you get bored? And guys, I don't. I really don't. I don't get bored saying the same thing every day because I have to say it 1,000 different ways because it's important to me that everybody gets it. And not everybody gets it in the same way. I'm going to share another picture. This is pretty cool. For you guys that struggle to follow rules, this was put in. I don't know if he wants credit for it or not. The gentleman that created this is over in the traders chat room, the owner's room. And there used to be what was called the pros room. So there was a time, guys, where there was a remedial class. And then when you posted and participated enough in the remedial class, you were granted access to the pros room. And this was made, and this probably came to be. He's had software close to 17 years, so this is probably 15 years old. But he knew what his things were. He knew where his challenges were. He knew the rules that he was willing to break, even inadvertently. And for every violation, he had a penalty. And what it did is it forced him to stop, to recollect, to look at his software, and to make sure that he's making good decisions. So missing a good entry, he penalized himself because it means that he wasn't in the moment, that he wasn't reading his indicators correctly, that he skipped it. So Paul, that 50-50 with one divergence that you got in late on, that's a 3-minute penalty, right? That's where you got to stand up, walk away, go scratch the dog behind the ears. Exiting for no reason. Exiting because of fear, not because of areas or divergences, right? That was 3 minutes. Arbitrary stop movement. Chumming the water. 5 minutes. Hoping areas break only to give it all back. It was 7 minutes. Trading against direction was a 10-minute timeout because really, who does that? Trading against an area was an even bigger one. And guys, this is 17 years old. This is the same stuff that Nexgen's been teaching for coming up on 3 decades. And it's all still true. All of these challenges are still trader challenges. All of these things, trading into an area, right? Hoping that an area breaks and not taking profits. All of these things are the same challenges that have been plaguing traders for decades. And we've taken all of those challenges and we have identified patterns and we've given you a very solid plan to not only avoid them, but to also capitalize on the same patterns. Whew. All right. All of my gum flapping. And you know what? You're right, Paul. And I don't know that it's tragic. I'm trying to think of a good analogy, and I stink at analogies. But, I mean, how many times have you touched a hot stove in your life, right? How many times it could be tragic that we do not listen, or it can be an opportunity to learn that you need to be a better listener. How's that for finding the positive? It's identifying that you need to work on your listening skills. But sometimes it's not even that you don't listen. Sometimes not taking the lesson in means that I didn't say it correctly. It means that I didn't say it in a way that relates to you. I didn't say it in a way that resonates. I find I look for it, guys. I broke everything that can be broken with this software. I made every mistake that can be made, and it doesn't make me a bad person. It just means that I'm stubborn. It means that I felt entitled to win because my last name is Novak, and I chose to avoid the path. And I think it's important that you make mistakes, and I think it's important that you break rules, and I think it's important that you trade in determination conditions, and I think it's important that you trade without momentum. Because when you do that, it opens the door, right? It opens the door for the listening. If you go through and you know that termination conditions are problematic for you, well, you can go back, and if you just played, let me find 20 times where price reached the market and the triggers didn't break, and let me see what the reaction is. Eventually, you believe it. So I don't know, guys. I'm running out of stuff. Let me see if I have anything else I can share. Everybody have a good weekend, I hope. Anybody do anything awesome this weekend? Had my kid in town. It's fun. Good time with my kid. Does everybody know about the YouTube channel that Nexgen has? With more information than you could shake a stick at? Ah, very nice. Arizona versus Stanford. You know, true story, Paul W., is my goal back when I was young and playing Little League. I had it all figured out. I was going to play catcher for the University of Arizona because they've always been a baseball powerhouse, and that was where I wanted to go play. And then I was going to come on, and I was going to be a catcher for the Houston Astros. That was my plan. So anytime I hear people, we had a client from Florida. His son played ball for University of Arizona. Yeah, my knees blew out, and I discovered marijuana in girls. So it didn't pan out, but for a while that was my plan. My youngest is 19, Rob. My oldest is 25. I somehow created amazing kids. Oh, right on. And yeah, the Discords are better because there's no commercials. YouTube has to have commercials. Otherwise, they'd have to charge everyone to do it, to look at it, I think. Plans change, right? They always do. Guys, I'm out. We can just BS. I don't mind. I